Housing payments are dropping. Right now, the median monthly payment in the United States has fallen to $2,413. That's the biggest decline since October 2024, and it's down 5.5% from last year. This is happening right now, in January 2026. But here's what nobody's telling you. This drop isn't because homes are getting cheaper. It's not because wages went up. And it's definitely not because the housing crisis is over. What's really happening is the White House just ordered a $200 billion intervention in the mortgage bond market. Trump gave the order in early January. Fannie Mae and Freddie Mac started buying, and mortgage rates started falling. So the question is this real relief, or just a temporary sugar high before things get worse? Let's start with what actually changed. On January 8th, Trump posted on Truth Social that he was directing his representatives to purchase $200 billion in mortgage bonds. He said Fannie Mae and Freddie Mac had the cash sitting there. His message was simple: buy the bonds, drive rates down, make housing affordable again. Within days, the average 30-year fixed mortgage rate dropped to 6.06%. That's the lowest it's been in more than 3 years. A year ago, rates were sitting at 7.04%. So we're talking about a 14% drop year over year. Here's the thing though, when mortgage rates drop, monthly payments drop, and that's exactly what we're seeing. The median payment went from around $2,550 down to $2,413. That's about $140 less per month. But this isn't a free market correction. This is government intervention. The White House is essentially forcing Fannie and Freddie to act like the Federal Reserve used to during quantitative easing. They're pumping money into the mortgage bond market to suppress rates artificially. And there's a reason this matters. Here's what the data doesn't tell you. The mortgage payment drop sounds like good news, but it's masking something much bigger. The housing market is still fundamentally broken. More than 75% of homes across the United States are unaffordable for most Americans. That's according to Bankrate. And in 99% of nearly 600 counties analyzed, homes are less affordable than historical averages. This was true in the last quarter of 2025, and it's still true now. The problem isn't just rates, it's supply. The United States is short roughly 2.8 million housing units right now. Some estimates put the shortage closer to 7 million when you account for extremely low-income households. And it's going to take about 10 years to close that gap, assuming we don't hit another recession. So, when you see mortgage rates dropping and payments going down, you have to ask, who actually benefits? If you can't afford to buy a house at $2,550 a month, you probably can't afford it at $2,413 either. The barrier isn't just the monthly payment. It's the down payment. It's the credit score. It's the lack of inventory in the right price range. And then there's the lock-in effect. About half of current mortgage holders are sitting on rates below 4%. 80% have rates below 6%. These people aren't selling. They're staying put because moving would mean taking on a significantly higher payment, even with rates at 6%. Let's talk about who this actually helps. If you're a mortgage lender or a real estate company, this is great news. Rocket companies jumped 9% the day Trump announced the bond purchase. UWM Holdings went up 13%. These companies make money on volume. Lower rates mean more refinances, more purchases, more transactions. If you're a homeowner who already owns, you might be able to refinance and save some money. But even that depends on what rate you locked in before. If you're sitting at 3% from the pandemic era, refinancing at 6% makes no sense. But if you're a first-time buyer, this barely moves the needle. Home prices are still up 60% since 2019. Inventory is still historically low. And even with rates at 6%, the monthly payment on a median-priced home is still out of reach for most households. Let's put this in perspective. According to Fannie Mae's own calculations, for affordability to return to pre-pandemic levels, one of three things would have to happen. Either the median home price would need to drop 38%, median household income would need to rise more than 60%, or mortgage rates would need to fall to 2.35%. None of those things are happening, and this $200 billion bond purchase isn't big enough to make that third scenario real. So what we're seeing is a temporary rate reduction that helps some people refinance, but doesn't fix the structural problem. And here's the kicker. Trump just spent the cash reserves that Fannie and Freddie were supposed to hold in case of another housing downturn. Not all markets are experiencing this the same way. The housing shortage isn't uniform across the country. It's worst in coastal cities and much less severe in the middle of America. California and Florida have been hit particularly hard. Home prices in these states are seeing the most drastic reductions, but that doesn't mean they're affordable. It just means they're correcting from extremely overheated levels. Meanwhile, the Northeast and Midwest are actually seeing prices push upward, with some areas showing 2.4% quarterly growth. Why? Because inventory in those regions is still tight, and demand hasn't cooled as much. The Sun Belt is another story. Places like Texas, Arizona, and parts of the Carolinas saw massive construction booms during the pandemic. Now there's a glut of new homes sitting on the market. Builders are offering rate buydowns just to clear inventory. They're paying money up front to lower buyers' mortgage rates temporarily. And then you have areas like Memphis, where there's an oversupply of high-end homes, but a shortage of entry-level properties. This is the mismatch problem. The homes being built aren't the homes people can afford. So what happens next? The $200 billion bond purchase might bring rates down another 1/4 to 0.5% over the coming months. Analysts at Redfin estimate that's the realistic impact, but that alone won't solve the affordability problem. The bigger risk is what happens if the economy weakens. Trump just drained the cash reserves that Fannie Mae and Freddie Mac were supposed to use as a buffer during a downturn. If we hit a recession, or if housing prices start falling significantly, these institutions are more exposed than they were before. There's also the question of inventory. Inventory growth has slowed from 33% year-over-year in mid-2025 to just 10% now. New listings are still the bottleneck, and baby boomers, who hold a significant amount of housing stock, are only gradually moving out of their homes. Meanwhile, Trump has also announced plans to ban institutional investors from buying single-family homes. But here's the reality. Institutional investors only make up 1 to 3% of the market, so that policy won't be a game changer. And if it also blocks large operators from building their own rental communities, it could actually tighten supply even more. The bottom line? 2026 is shaping up to be a year where housing doesn't crash, but it doesn't improve much either. Prices will likely stall at 0% growth nationally. Some regions will see declines, others will keep rising, and most Americans will still be priced out. Housing payments are down, rates are falling, and the headlines make it sound like relief is finally here. But beneath the surface, the fundamentals haven't changed. Supply is still short, prices are still high, and most Americans are still locked out. The $200 billion bond purchase isn't a fix, it's a Band-Aid. And like all Band-Aids, it might make things feel better for a while, but it doesn't heal the wound. If you're waiting for the housing market to return to normal, you might be waiting a long time, because the new normal is higher prices, limited inventory, and government intervention just to keep things from getting worse. This isn't advice. This is just what the data shows. Make your own decisions, but know what you're looking at.